Welcome to Delphos Insights. This is episode 37, where we examine infrastructure trends in emerging markets in 2026 and what investors require. So today, we're exploring, well, a massive structural shift. I mean, you always hear about this $7.5 trillion annual investment gap in emerging markets.
Right. It's a number that gets thrown around constantly.
Exactly. But we really need to reframe how we look at that figure. It is not a lack of capital.
No, it's a structuring gap.
Right. Think of it like a booming real estate market.
Yeah.
The buyers exist, they have the funds ready to deploy, but they just refuse to buy houses with hidden foundational cracks. And the demand is absolutely there. I mean, emerging markets and developing economies are projected to grow at over 4% compared to around 1.5% in advanced economies.
Yeah, that growth disparity is huge.
So if the growth and the demand are undeniable, why aren't these massive infrastructure projects actually absorbing the available capital?
Well, the answer lies in a really fascinating data disconnect. If you look at global foreign direct investment, it actually rose 14% in 2025.
Right, which tells us institutional investors clearly want that broad exposure to growing regions.
Exactly. But look closer and you'll see international project finance actually dropped 16% over that exact same period.
Wow, a 16% drop.
Yeah, this divergence is the core issue here. Investors actively want the market exposure, but they are flatly rejecting specific mispriced project risks at the asset level.
Okay, so they want the neighborhood, but they are walking away from the specific houses.
That's a perfect way to put it.
So let's look at the houses they are actually buying. The data shows transport, digital infrastructure, and climate-resilient water systems are really capturing the capital. I mean, private participation in these sectors secured $100.7 billion in 2024.
And that momentum is continuing.
Right. Looking forward, new subsea cable investments alone will exceed $13 billion. So the common denominator seems to be highly predictable cash flows.
Absolutely predictable cash flows are key.
But that brings us to the more important question, right? What is actually killing the deals that fail?
Well, they consistently fall apart due to three mispriced risks that prevent a project from ever reaching financial close. First, you have political instability.
And that's not just about elections, right?
No, I mean, it's about sudden regulatory shifts or, importantly, currency devaluation. Second is climate exposure. That's both the physical damage from extreme weather and the risk of an asset becoming obsolete, due to the global energy transition.
Right, stranded assets.
Exactly.
Yeah.
And third is project delivery failure, meaning the severe supply chain collapses and cost overruns that frequently disrupt frontier markets.
Let's pause there and look at the actual mechanism. I want to give the listener a concrete example of how this plays out. How does something like, say, currency devaluation actually blow up a deal in practice?
It's a classic structural mismatch. I mean, imagine you're building a new transport system, like a toll road.
Okay, I'm with you.
You're collecting tolls from local commuters in the local currency, but you have to pay back your institutional loans in US dollars.
Ah, I see where this is going.
Right. If that local currency suddenly tanks, your revenue is worth a fraction of what it was. Your project effectively goes bankrupt overnight, even if the road is packed with cars.
Wow. But wait, I want to push back on your third point about project delivery and supply chains. Isn't managing local labor shortages or delayed materials just a standard operational issue for the construction phase?
You would think so, but no.
I mean, why does an institutional lender sitting in London or New York care about a local cement shortage before they've even signed the paperwork?
Because to that institutional lender, those aren't just operational hiccups. They are structural flaws in the foundation.
Right.
If extreme weather causes a supply chain collapse, which then delays construction by 2 years, the entire financial model fails before a single dollar of revenue is ever generated. Lenders look at this through a totally different lens.
So they require disciplined risk allocation upfront.
Exactly. You can't just fix it on the fly.
Which brings us to the solution. How do we reinforce the foundation of these deals so investors actually write the checks? We hear terms like partial risk guarantees, robust performance bonds, and concessional tranches.
Yes, the heavy structural tools.
Right, but what do those actually do for the investor?
Think of them as the structural engineer's guarantee that the house won't collapse under pressure. A concessional tranche, for example, is essentially a shock absorber in the capital stack.
A shock absorber, okay.
Yeah, it's often capital from a development finance institution that agrees to take the first financial hit if something goes wrong.
So the private institutional investors don't have to.
Exactly. A bankable asset requires early alignment with these institutions. You cannot just rely on optimistic public sector projections.
Right, you have to structurally bake those guarantees and bonds into the model from day one to protect the capital.
Precisely. You have to price and allocate the risk transparently before you ever ask for the capital.
So the practical implication for you, whether you're allocating capital or structuring a deal, is that funding only flows when aspirational public sector ideas are rigorously transformed into commercially viable, protected assets.
Yes, the ultimate barrier isn't a lack of liquidity, it's a deficit of investment-grade preparation.
As you prepare for your next allocation, ask yourself, does your proposed asset transparently price and mitigate delivery and governance risks to meet investment committee readiness, or does it merely rely on public sector ambition? This has been Delphos Insights. Learn more at delphos.co.